All right, let's talk about CSW Industrials. We're digging into their first quarter earnings for fiscal 26. Now, on the surface, everything looked great. A record quarter, in fact. But the way the stock traded that day, well, that tells a completely different and much more interesting story.
So let's just jump right into the price action on earnings day, because it perfectly sets up the mystery we're about to solve. Before the market even opened, shares went on an absolute tear, surging 13% on the headline numbers. You'd think it's going to be a great day, right? Wrong. The moment the earnings call kicked off, all that excitement just vanished. The stock drifted down, and by the closing bell, it was actually down 3.5% for the day. Wild.
So that brings us to the big question, the reason we're all here. How does a company report record results, a solid EPS beat, and still end up with its stock in the red? What on earth did the market see that soured the mood so fast? Let's get into it.
All right, first up, let's look at the good news. What exactly was in those headline numbers that got everybody so fired up in the pre-market? And yeah, you can see why people were excited. The headline results looked fantastic. Adjusted earnings per share, or EPS, came in at $2.85. That's a solid 4% beat over what Wall Street was expecting. Revenue, up almost 17% from last year. EBITDA, up over 5%. And look at that free cash flow, nearly $58 million. I mean, on paper, this is a slam dunk. It's exactly the kind of report you want to see.
Okay, so if the headlines were so good, what went wrong? This is where the story gets really interesting, because as soon as people started actually digging into the details and listening to management on the earnings call, let's just say a very different picture started to come into focus.
And here's the very first crack in the armor. You see that EPS beat? Awesome. But the top-line revenue number, well, that was a pretty significant miss. The street was looking for around $277 million. CSW delivered just under $264 million. We're talking a $13.4 million shortfall. Ouch. That was clue number one that maybe the quality of this earnings beat wasn't quite as shiny as it looked at first glance.
Now, to really get what happened next, we got to quickly cover two key terms: organic versus inorganic revenue. Think of it like this. Organic growth is sales from your existing business, the stuff you've always been doing. Inorganic growth is when you just go out and buy another company to bolt on their revenue. And believe me, this distinction is everything when it comes to understanding CSW's quarter.
Okay, and this chart right here is the smoking gun. This is what spooked investors. Look at the total revenue growth. It was all, and I mean 100%, due to that inorganic acquisition-based growth. We're talking nearly $44 million from companies they just bought. So what happened to their actual core business? It went backwards. It shrank by almost 3%. So what the market saw wasn't a healthy growing company, it was a company using acquisitions to paper over some real cracks in its foundation.
So, of course, management had to explain this, right? And they pointed to a few things. They talked about softness in the housing market, which makes sense. They mentioned they were up against a really tough comparison from last year when a big customer loaded up on inventory. And this is a big one. They pointed to a consumer trend of repairing old HVAC units instead of splurging on a brand new one, trying to save some cash. And that whole repair over replace thing, that's a huge headwind for the entire industry at the moment.
And if the shrinking core business wasn't enough, here's the second punch: margin pressure. A big drop. Gross margin contracted by 370 basis points. That's 3.7 percentage points, which is a huge move for one quarter. So let's put this all together. Not only is your core business selling less stuff, but the stuff you are selling is becoming less profitable. It's a double whammy. And it's mostly because those companies they bought just aren't as profitable, plus costs are going up.
Okay, but here's the twist. None of this was really an accident. This is all part of a very deliberate, very calculated pivot by the company. The market's concerns are totally valid, but you have to hear management's side of the story to get the full picture.
And they're not shy about it at all. This quote from them says it all. They're basically saying, hey, we're evolving. We're using disciplined M&A, that's mergers and acquisitions, to build a massive HVAC platform. Their goal is to become one of the biggest players in the game by buying up other companies.
And you can see this strategy playing out in real time. Just look at their revenue breakdown. That contractor solutions slice of the pie, that's where all the HVAC action is, and it's now a whopping 74% of the entire business. They are absolutely all in on this.
So here's their game plan, broken down into 4 simple steps. Step 1, acquire scale. Go out and buy companies to get bigger. Step 2, absorb the hit to your margins. They know this is going to happen, and they're okay with it for now. Step 3, use that new, bigger footprint to steal market share from competitors. And finally, Step 4, once you're the big dog, you can compound earnings over the long run. It's the classic short-term pain for long-term gain playbook.
So, now we have the two sides of the coin, right? The bull case, which is this big, bold acquisition strategy, and the bear case, which is the ugly organic growth and margin numbers we just saw. So, let's synthesize it all and put our official rating on CSW.
Look, the argument for the bulls is pretty straightforward. The M&A strategy is driving growth, no doubt about it. The company is a cash machine, and it has very little debt. Plus, management didn't back down from their full-year guidance. But the bears have some serious ammo here. That organic decline is just scary. The margin compression is real, and it hurts. And they're trying to pull off this big, complicated integration at a time when the whole housing market is soft. That's a lot of risk.
All right, so after weighing everything, where do we land? We are initiating coverage on CSW Industrials with a rating of market perform. What does that mean? Basically, we think the stock is going to trade right in line with the rest of the market for the time being. No major outperformance, no major underperformance.
So here's the why behind our call. The grand vision, the acquisition strategy, it could work, it's plausible. But right now, the market is rightfully skeptical. We all need to see some proof that this is a real strategy and not just a way to hide a struggling core business. So looking ahead to the next quarter, Q2, here's what you need to watch. 3 key things. Number 1, organic growth in their main contractor solutions segment. Does it actually get back to growing like they said it would? Number 2, gross margins. Do they finally bottom out, or does the bleeding continue? And number 3, we'll be listening for any color on how that big Aspen integration is going. The answers to those 3 questions will tell you everything you need to know about where this stock is headed next.
And as always, just a quick reminder that this analysis is for informational purposes only. It is not financial advice.